Hello, you see, we are starting the daily benefits update, but first, like the video and subscribe to the channel. If you have searched for information about the 2026 IRS changes and why some seniors are seeing differences in their Social Security payments and found three different explanations depending on where you looked, that is because the IRS changes affecting seniors in 2020 or 26 involve more than one mechanism, and each mechanism touches Social Security income in a different way. Some sources focus on the updated standard deduction. Some focus on the adjusted tax bracket thresholds. Some mention changes to how Social Security benefits are taxed. And all of those are real 2026 IRS updates. They just affect different seniors in different ways depending on their total income, their filing status, and whether they have Social Security income or other retirement income alongside it. Today, we're going to go through the 2026 IRS changes that are most relevant to seniors who receive Social Security, explain exactly how each one works, and show what the updated numbers mean for your 2026 tax return directly from IRS publications and irs.gov in plain English. I am Andrew, and I have spent time going through the IRS's 2026 inflation adjustments, the updated standard deduction figures, the revised tax bracket thresholds, and IRS publication 554, the tax guide for seniors as it applies to Social Security recipients. Everything here comes directly from irs.gov and the IRS's officially published 2026 tax year parameters. Before we get into this, if you find this kind of plain language explanation of IRS rules and how they affect Social Security recipients useful, subscribe and turn on notifications. Every week, this channel covers one benefit topic in the same straightforward format with no pressure and no alarm. Now, let us get into exactly what changed with the IRS in 2026, how those changes interact with Social Security income, and what seniors need to understand about their tax situation for the 2026 filing year. The most common misunderstanding about IRS changes affecting Social Security is that if the IRS updates its rules, it means the SSA changes what it sends to recipients, that an IRS announcement about tax brackets or deductions directly alters the Social Security payment amount itself. This misunderstanding is completely understandable because both agencies affect the income a senior ends up with each year, and it is natural to blur the line between them when both are changing in the same year. But here's how it actually works. The SSA determines the gross benefit amount, which is governed by the Social Security Act. The IRS determines how much of that benefit is taxable and what standard deductions apply to reduce the tax owed on it. The two agencies operate independently. An IRS change does not alter what the SSA sends. It changes what the recipient owes in taxes on what they receive, which in turn affects their net after-tax income. The 2026 IRS changes that matter most for Social Security recipients are the updated standard deduction, the revised tax bracket thresholds, and the unchanged but widely misunderstood Social Security taxation formula. We are going to go through each of these in detail so that by the end of this video, you have a complete and accurate picture of how the 2026 IRS updates affect the tax side of your Social Security income. To make this concrete, let me use an example. Consider someone like Beverly. Beverly is 71 years old, lives in Savannah, Georgia, and worked for 30 years as a medical records administrator before retiring at 67. She receives a Social Security retirement benefit of $1,840 per month and also takes a $12,000 annual distribution from a traditional IRA she built during her working years. When Beverly read about the 2026 IRS changes affecting seniors, she believed the IRS had changed the rule about whether Social Security is taxable, that perhaps the new rule meant less of her benefit would be taxed, or that the taxation formula had been updated. Here is what was actually happening. The IRS did not change the Social Security taxation formula in 2026. The formula, which uses combined income to determine whether 0%, 50%, or 85% of benefits are taxable, remained unchanged. What did change was Beverly's standard deduction and the tax bracket thresholds, both of which adjusted upward for inflation in 2026. Beverly's standard deduction as a single filer age 65 or older increased from $15,700 in 2025 to $16,950 in 2026. Her combined income, $12,000 IRA plus half her Social Security of $11,040, totaling $23,040, puts her in the range where 50% of her Social Security is potentially taxable. but the higher standard deduction means a larger portion of her income is shielded before tax rates are applied, resulting in a slightly lower tax bill than the prior year's calculation would have produced. Beverly's Social Security payment did not change. Her gross income did not change. Her after-tax income improved modestly because the 2026 standard deduction increase reduced her taxable income by $450 compared to 2025. Understanding that the IRS change affected her deduction, not the SSA's payment, would have answered her question immediately. The 2026 standard deduction increase for seniors. Let us start with the foundation. Each year, the IRS adjusts its standard deduction amounts for inflation using a formula tied to the Consumer Price Index. According to IRS Revenue Procedure 2025-28, which sets the 2026 tax year parameters, the standard deduction for single filers in 2026 is $14,600. For married couples filing jointly, it is $29,200. However, taxpayers who are age 65 or older receive an additional standard deduction on top of the base amount. According to IRS Publication 554, the tax guide for seniors, the additional standard deduction for a single filer age 65 or older in 2026 is $1,550. Combined with the base deduction, a single senior filer's total standard deduction is $1,650. For a married couple where both spouses are 65 or older, the additional deduction is $1,550 per spouse, bringing the total standard deduction to $3,300. You might be wondering, how does this change what I owe compared to 2025? The answer is that if your income stayed roughly the same, the higher 2026 standard deduction reduces your taxable income by approximately $450 more than the 2025 deduction did for a single senior filer. At the 12% tax bracket, SIAM, which covers most middle income retirees, that translates to approximately $54 less in federal income tax owed for 2026 compared to the prior year's calculation. For married couples filing jointly where both spouses are 65 or older, the reduction is approximately $104 less in taxes at that bracket level. The 2026 tax bracket threshold adjustments. Now that we understand the standard deduction changes, we can look at the tax bracket adjustments. The IRS adjusts the income thresholds for each tax bracket annually to account for inflation. According to the IRS's 2026 inflation adjustment tables, the 10% bracket for single filers now covers taxable income up to $11,925, up from $11,600 in 2025. The 12% bracket covers taxable income from $11,925 to $48,475, up from the 2025 upper limit of $47,150. This next part is where it gets more specific. For Social Security recipients, the tax bracket threshold that matters most is the one that determines whether a portion of their combined income falls into the 22% bracket rather than the 12% bracket. In 2026, that threshold for single filers is $48,475 in taxable income, meaning a single senior whose taxable income after standard deduction falls below $48,475 pays no more than 12% on their federal income tax. Because the bracket widened slightly from 2025, some seniors whose income was near the 2025 boundary now fall entirely within the 12% bracket in 2026. This applies in most cases. The exception involves seniors with significant income from multiple sources, such as pension income, large IRA distributions, and investment income on top of Social Security, whose taxable income puts them into the 22% or higher brackets, regardless of the threshold adjustments. For those recipients, the bracket widening provides a modest reduction in the amount subject to the 22% rate, but does not change their overall bracket position. In Beverly's situation specifically, her taxable income after the $16,150 standard deduction is calculated as follows. Her IRA distribution of $12,000 plus the taxable portion of her Social Security, 50% of $22,080, which is $11,040, gives her $23,040 in gross income subject to taxation before the standard deduction. After the $60,150 deduction, her taxable income is $6,890. that amount falls entirely within the 10% bracket, meaning her federal income tax on that income is approximately $689. The 2026 standard deduction increase reduced her taxable income by $450 compared to the same calculation under 2025 parameters, saving her approximately $45 in federal tax. The Social Security taxation formula unchanged in 2026. And finally, yes, this is the piece that ties everything together. The formula used to determine how much of a Social Security benefit is subject to federal income tax has not changed in 2026. So, according to IRS publication 915, Social Security and equivalent railroad retirement benefits, the combined income thresholds that determine the taxable percentage of Social Security benefits are the same in 2026 as they have been since 1993. $25,000 for single filers and $32,000 for married couples filing jointly for the 50% threshold, and $34,000 and $44,000 respectively for the 85% threshold. You might be wondering, if these thresholds have not changed since 1993, does that mean more seniors become subject to Social Security taxation each year as their benefits increase with COLA? The answer is yes. Because the thresholds are not adjusted for inflation, the annual COLA increases that raise Social Security benefits can push some recipients above the thresholds over time, resulting in a larger taxable portion of their benefit, even without any change in the law. This is a structural feature of the Social Security taxation rules, not a new 2026 policy change. The maximum Social Security retirement benefit for a recipient who claimed at full retirement age in 2026 is $4,018 per month or $48,216 annually. For a recipient at that benefit level, half of their Social Security, like 24,108, counts toward combined income. Combined with any other income, most high benefit recipients fall above the 85% threshold and have 85% of their benefits subject to taxation. The average benefit of approximately $1,176 per month, $23,712 annually, results in combined income that for recipients with modest additional income typically falls in the 50% taxable range or below. One thing worth understanding about how the 2026 IRS changes connect to Medicare is that modified adjusted gross income, which includes the taxable portion of Social Security, is the figure the SSA uses to determine IRMA Medicare premium surcharges. The 2026 standard deduction increase reduces federal income tax owed but does not change MAGI because MAGI is calculated before standard deductions are applied. A senior whose gross income is near an IRMA threshold should be aware that the standard deduction increase does not lower their IRMA calculation. This is not a warning and just something worth knowing so you have the complete picture. Before we finish, let me answer three questions that come up most often about the 2026 IRS changes in Social Security income. Question one, did the IRS change the rule about how much Social Security is taxable in 2026? Answer, no. The Social Security taxation formula and its combined income thresholds, $25,000 and $34,000 for single filers, were not changed in 2026. What changed are the standard deduction amounts and the tax bracket thresholds, both of which adjusted upward for inflation. The formula used to determine whether 0, 50, or 85% of your benefit is taxable remains the same as it has been since 1993. Question two, my Social Security income is my only income. Do I need to file a federal tax return in 2026? Answer, not necessarily. If Social Security is your only income, your combined income, in which is half of your annual Social Security benefit, is likely below the $25,000 threshold, where Social Security becomes taxable for single filers. In that case, you may have no federal income tax obligation and no filing requirement. The IRS Interactive Tax Assistant at irs.gov can confirm whether filing is required for your specific situation. Question three, I had federal taxes withheld from my Social Security in 2025, but I'm not sure if I should continue in 2026. How do I decide? Answer, whether voluntary withholding makes sense depends on your total income and expected tax liability for 2026. If your combined income exceeds the thresholds where Social Security becomes taxable, withholding can prevent an unexpected tax bill at filing. You can request or adjust voluntary withholding from Social Security by completing Form W-4V and submitting it to the SSA. The withholding rate options are 7, 10, 12, or 22%. Everything we covered today applies generally, but your specific income sources, filing status, and deduction situation may have details that change how the 2026 IRS updates affect your tax return. The most reliable way to get your exact answer is irs.gov, where IRS Publication 554, the Tax Guide for Seniors, and IRS Publication 915, Social Security and Equivalent Railroad Retirement Benefits, are available free of charge and cover the specific calculations in detail. The IRS Interactive Tax Assistant tool at irs.gov can also walk you through whether your Social Security is taxable based on your specific income. For free in-person tax preparation help, the VITA program and AARP Tax Aid offer free filing assistance to seniors at locations across the country. For Social Security income questions, the SSA main line at 1-800-772-1213 can confirm your current benefit figure. These resources are free. They are official, and they will give you answers specific to your situation, not general answers like this video does. One factual note before we finish: the IRS communicates by mail, not by phone calls, claiming the 2026 IRS changes have created a new tax obligation that requires immediate payment, not by texts saying your Social Security income triggered an audit, and not by emails asking you to verify your personal information to process a 2026 tax adjustment. If you receive communication like that, it is not from the IRS. You can verify any IRS communication by calling 1-800-829-1040 directly. I am curious, was there a specific part of the 2026 IRS changes and how they affect Social Security income and the standard deduction, the tax brackets, or the taxation formula that you found most unclear before watching this? Leave it in the comments. The most common questions become future videos. That is the 2026 IRS changes and how they affect senior Social Security income, explained as clearly as I can put it. If something is still unclear, the comment section is open and I read every question. If this was useful, share it with someone who heard about the IRS changes and was not sure what they meant for their Social Security situation. I am Andrew. I will see you in the next one.